Good day, all. Ira Epstein of Linn Associates with your weekend edition of your agriculture update. And this is for Friday. And we are now at the 15th of February, 2019, and we're about 2:35 in the afternoon. So you can see the stock market's a powerhouse. The metals are strong. The dollar a bit weaker after making a new high for the move, but it really didn't lift most of the currencies with it, which was interesting. In the soybeans, up on the day a little bit, down in the other markets. And of course, the event of the day was watching President Trump. Couple of things. We have a budget, no government shutdown. Number two, he's declared the national emergency. And then one final event is, of course, the Chinese trade deal going into a next week, another meeting. I guess the Chinese are coming here for a letter of memorandum, trying to figure out where they're at. The one thing that seems to be a given is the Chinese will buy more goods from America. The problem with the trade seems to be intellectual property, how the government, the Chinese government, subsidizes state-run businesses, dumping of products. I can go on, but that seems to be where you're at. But the market likes it in terms of energy, too. So when we go into the weekend edition, you know, one of the things that we do is we start off with a monthly chart, and then we go to weekly charts. And the idea here is to get the bigger picture view, and then typically Monday through Thursday we do the daily charts, one weekly chart and then the daily. So when we look at the monthly chart first, we still haven't been able to get over this key resistance area, and I'm going back now to 939.5 roughly, and that's been that way for the most of the 2018 year and certainly all of 2019 so far. If we look at where the market came from, and obviously I'm back at the high made in 2018, which was the 1071. We then broke down in the summertime, last summer, into the 810.5 zone. And on a weekly chart, if you put a Fibonacci count, you've made a 38% retracement, and this is where the market is stalled out. If the market can lift over the highs back here of 3 weeks ago now, I would then look for the market to maybe make it to that 940 level. Barring that, you're into the resistance zone. When we take a look at swing lines, and what this is this type of bar chart, but I've put onto it a study that I wrote called a swing line. And what a swing line does is it looks at the market, and each bar looks at what the previous bar was, and then a set of 5 rules that I developed tells you if the line's going to be drawn to the up or down. It looks to see, do you have an outside day up, outside day down, an inside week, or a lower high, higher low week. Which one's going on? So in this case, you've got higher lows, higher highs. I define that as what? An uptrend. To break the uptrend, the market has to get back under right here, this low, and we can look at it exactly as being 890.75. It's right over my shoulder here. So that's where you're at now. Let's put on some moving averages. The key moving average, the one that I call the line in the sand, because it's often where a market decides what it's going to do next from, is the 18-week moving average of closes. And as you can see here, it fought a battle, came down, found the support, went up, found the support again. Now the question is if it gets here. If it gets down to 894.75 and doesn't take out 890.75, the trend is still up. You'd have to take out 890.75, so support is before that number would be hit. When I look at Bollinger Bands, which are these black dashed lines, what they are an algorithm designed to keep the market trading within them 95% of the time. Now, it's important to notice what the band is doing. Sometimes they're going sideways, and from sideways action, you often get a breakout one way or the other. In this case, that's not what's going on. The trend has been gradually moving to the upside. So the support comes in here, and the resistance is against this band, and as you can see, there's pretty strong resistance between the combination of a 100-week moving average and the upper Bollinger Band. I then look at momentum. That's the last piece I put on the market. I believe that momentum often leads price. Is it every single time? No, but it's most of the time. Go back and do your own work. The other thing I do different on weekly charts is I do not believe that momentum on a weekly chart gets overbought or oversold. It's either pointing up, going flat, or pointing down. In this case, it's turned down. So what we have is momentum is down. You can see the red line is underneath the blue, starting to point down, the red and the blue there, called the K and D lines actually. Support comes in at the 18-week moving average. I'm going to say the bias of the chart, because it's been in this pattern of with the higher highs, higher lows, and over the 18-week averages up. So momentum saying maybe the market's ready to pull back to that moving average. In the meal market, this is total sideways action. Do you see the difference of the look here? How narrow you are? Now I'll give you an idea of how you get chopped up. Here is a market that went to the upper Bollinger Band, pulled back, goes to that number again. It never did get up and stay over that number, which could have put into place the 100-week average. If you take out the low right here, and that low this week is 306.90, then it would put into play getting to the lower moving average, the lower Bollinger Band for support at 303.40. The market went up, and this is the week of February 1st. Here's the week of February 8th, and here you are right now, making your run towards that number. The low 304.30, 303.40 is that number, and you still have momentum pointing to the downside. Like it failed on the upside to break out, it still has not broken out to the downside. Now, if it breaks out to the downside, don't be surprised that you get under and start pushing this band down. One of these times it'll break out one way or the other. In the soybean oil, the market had a heck of a run to the upside. You can see, by the way, here was that sideways action again that we talk about. Got to that number, and now what's happened is your momentum's picking up, the market's getting over. If it can keep going, maybe the 100-day average becomes the next resistance. The market makes another stab, gets up pretty high to 31.01, not quite to that 100, starts faltering, and this is where you're at right now. A market that's now pulled back under the Bollinger Band. Markets will trade within these black bands 95% of the time, but any way that I look at the chart, it's broken out to the upside. It can lose its uptrend by taking out 29.65, which might imply a break all the way back to 28.55, but the bigger picture is this low here seems to be a low of importance right now. In the corn market, you have been fighting at the 18-week moving average of closes, and if you go to the daily charts, which I often flip back and forth on, you've been hitting this 18-day average. If you go to a 2-week period, it's almost every day of that, in fact, longer than that. Now the close today puts the market still over the 18-week average. 373.25 is that number. You close 74.75. Therefore, what we have in the market is very simple. You have a market that's got upside bias. Momentum has been slipping to the downside. The pattern is one of lower highs and lower lows. It's a market that's neutral right where it's at. In the wheat market, this was an attempt at a false breakout. Take a look at the rally last week. It failed at what number? That 18-week moving average of closes. This is that sideways action. Something else was happening. You pulled back down and momentum had started pointing down. If you take out this 310.75, what do you put into play? The lower Bollinger Band, where the market basically is down at, right in that zone now. The low of the week was 499.25. You're 498.5. You don't have to go much through it. Let's assume it does. Let's assume the market decides to start pushing out down here. Momentum's still pointing down. That could put into play ultimately the 100-week moving average of closes. Are we trending? No. You have a higher high, lower low. In the cocoa market, the cocoa took off today, especially today, in a big manner. You were up now for the week 111 points. You can see this. The market's old high was 23.04. You got to 23.16 today. Weather is the factor that they're looking at now as to where the cocoa plants are growing. The market fell down, though, last week to the combination of support at the 18-week and the 100. The trend had been down, lower highs, lower lows. If the market were to continue down, possibly you go to the next support zone of 2061. What would stop the trend? Getting over 23.04, which it did now. So you're out of the downtrend. You're not in an uptrend. Momentum is trying to turn up. The bias is up, but you don't have the higher lows, higher highs. What you really are caught in if you study it and look at the sideways action of the Bollinger Bands, is a broad sideways action that has not been weak enough to get to the lower band, but it has been strong enough to hit the upper band. In the sugar market, you've developed this sideways action also. Can you see right here how the bands are narrowing in again? Momentum is up. The trend is up because you have higher lows, higher highs. The first resistance point is the 100-week average right here if you clear this. And that's where you're at right now. If you can clear it again, get through this, then the upper Bollinger Band of 1380 becomes another target. Coffee is in a downtrend, and coffee has had a heck of a time. It's tried to get back to what I call that line in the sand. Remember, each bar here is a week. Numerous times has failed. It is pointing down, the trend is down, the bias is down, momentum is down. You're in a downtrend unless you can get back up and over 106.35. In the cotton market, you're in a downtrend as well. You have the lower highs, you've had the lower lows, momentum is pointing down. Remember, I don't consider momentum overbought or oversold. You've hit again a downside target. The downside target was 70.22, you're 69.55 this week is a low, I believe 53, and you're back to right at that number at 70.22. The cattle market today was a bit of a bummer. The market has been trying to go up and it keeps failing, and now you're getting one of these reversal weeks. If you should take out this 124.70, be careful. Could be a sign this market's ready to pull back to the 18-day average. As it is, even though the chart action wasn't good on this week, you still have the higher lows, you have the higher highs, but this could be, when you open next week, if you take out this week's low, a pattern of lower highs and then higher lows. So you're narrowing in like that. Be careful of that. In the hog market, you don't apparently want to stay very long, at least the chart action says that, on the under the 18-week average of closes. Momentum is trying to spin to the upside. The market has a pattern of lower highs, lower lows, so I'm going to call it neutral. Why? You closed over the 18-week average, so the bias is up, momentum is up, but the swing line trend is down. Look how the Bollinger Bands are falling and raising as well. What are hogs about? Well, if we get a Chinese trade deal, a lot of people think pork could be one of the elements there. The Chinese want to buy goods. They don't want to give up on the intellectual property or the state subsidies. That's the bigger problem. As for trade, I think the president's getting a lot of what he wants. You know, one of the things we love to do here, and we do a pretty good job of it, I think, is write about these markets. And we have a staff that writes, and I'm telling you, they'll be writing all weekend, including President's Day, and they write on all these different markets. And no, you don't have to receive the information on all of them. You pick the market topics you want, or you don't have to take any of them. That's up to you. I mean, where you go. But our clients get all this, and it's all included in being a customer of ours. If you'd like to see what our customers get, because we write for hedgers, we write for derivatives, we write for the options people, we write for the futures, simply give us a call. Go to our website. You can sign up for any of our free offers there, and away you go. You know, one of the cool tools we have is our mobile application, because all this information comes right in there. You just hit it, and you're reading all our data. In fact, my videos are there as well. I'm Ira Epstein. You have a great weekend. I'll see you all come Tuesday. Take care.